end of the video because I'm going to go over how you can prepare to make sure that you're secure in what could be one of the greatest financial crises in U.S. history. Let's dive right in. First, let's discuss how a pension fund actually works, and then let's dive into the specific problem we have right now. State pension funds take contributions from employers, which are basically taxes, and they combine that with the contributions from the employees. That, with the investment returns, gives them what they need to meet their obligations. And the pension funds say to the workers, okay, if you give us this much right now, we'll take that money, we'll invest it into different assets, and then when you retire, we'll give you this much back in the form of retirement benefits. The workers see that, and they say, okay, that seems to be a pretty good deal. So the workers throughout their entire work life, let's say 20 to 30 years, they're planning on getting this much for retirement. So that means that they're consuming more and they're saving less because they think that there's going to be this pot of gold at the end of the rainbow, because that's what the states and the pension funds, that's what they promise them. Well, that makes sense. And this all works out as long as the pension funds can realize a 7% annual return on the money that is coming into the fund. As long as they make that 7% per year, then the fund has all the money that it needs to pay the workers when they retire. So now let's dive right into the heart of the problem. Going back to 2002, the Federal Reserve lowered interest rates because of the dot-com bubble. They wanted to paper over that problem with even more debt. So they dropped rates down to about 1%. In a 1% interest rate environment, it's extremely difficult to achieve 7% returns for these pension funds. The amount of money that they have to distribute goes down. So what that would look like is this bar that we've got here depicting the amount of money in the fund, or the amount of money going out to workers, would go down to here. But remember that the expectations of the workers are right here. So they say, well, no problem, we can make up for that in the future years by maybe adding a little bit more in the taxes, or by achieving maybe an 8% return, or maybe even a 9% return. And everyone kind of breathes a sigh of relief saying, okay, well, that'll fix the problem. Well, then what happens, in addition to the Federal Reserve lowering rates, is because of this boom and bust debt cycle that we've had in the United States, the politicians were short on money to fund all of their other projects. So what they did is they saw all of these taxes coming into the pension funds and say, well, you know, if we really take $1 billion out of the taxes going into the pension fund this year, is it really that big of a deal? Because, you know, I mean, we're going to get this 8% moving forward, and at 8%, we're actually overfunded. So what we're going to do is we're going to steal a little bit of money from the kitty. And then the next year, the politicians do the same thing. The next year, they do the same thing. Well, what happens after 10 or 15 years of doing this is the amount of money going into the pension funds was nowhere near what it should have been to make sure that the worker was getting what they were expected. And then you combine that on top of the fact that the pension funds haven't been able to achieve that 7% return because the Federal Reserve has kept interest rates so low. You get this situation where these pension funds are massively underfunded. So this whole setup creates a lot of unintended consequences that makes matters worse. The funds need a 7% return, and they can't get that because the Fed drops rates. Plus the politicians are stealing from them. So what they do is they look at the corporate bond market and they say, wow, these guys are paying 4%, which isn't bad and it seems quote unquote safe. So they lend them all this money, but if they just lend them money, then they're only getting this 4%. So what they do is they lend them money with leverage, meaning they borrow more money than they actually have to lend them. And you can tell where this is going, right? So they do that to get this 7% or maybe 8% that they need. The corporations love that because they're getting super cheap money, and they take all that money and they just buy their own shares back. So when they buy their own shares back, this makes the stock market, of course, go up. What's crazy is if you look at the stock market or who's been the buyers in the stock market since 2010, the main buyers in the stock markets have been corporations just buying their shares back. This is all complete financial engineering. In other words, the stock market has gone up, or the majority of the stock market gains from the past 10 years hasn't been from fundamentals or anything that's actually good. It's strictly been from corporations buying their shares back. Now, this is all fine and dandy when it's actually working. Where we run into a problem is when we get into the next recession. Now, keep in mind, the United States has had recessions from 4 to 8 years throughout the span of its history. And we are 10 years in to an expansion right now. This is the longest expansion that we have ever had. So statistically, this needs to come to an end, or should come to an end very soon. When it comes to an end and we actually get a recession, the first thing that's going to happen is the stock market is, of course, going to go down. If the stock market goes down, the value of all these shares that the corporations have purchased also goes down. If that happens, their debt gets downgraded. If their debt gets downgraded, then most of these funds are going to have to sell it, because the funds by law can only buy debt that is BBB. And I don't want to go off on a tangent, but most of the corporate debt right now is rated BBB. It's right on that line. So if you have forced selling of these bonds by the biggest buyer in the market, that's going to increase the interest rate. It's going to make their debt more expensive. If their debt gets more expensive, it costs more to service that debt, which makes their shares go down even further, which makes the stock market go down even further. And because these funds have to liquidate at ever lower prices, that means that the delta between what they promised all of those workers and what they actually have gets even greater than it was before. This brings us to the question, where are we now? How underfunded are these pensions? I've got a chart right here, and on the left, we've got trillions of dollars, ranging from 9 trillion at the top down to 1 trillion. Our horizontal line represents return on assets. So if these pension funds realize a 7.5% return, currently they're underfunded by $2 trillion. This 7.5% return is completely unrealistic in my opinion. Going over here to a 2% return, which is basically the return on a 10-year treasury, they're all the way at $8 trillion. That means there's an $8 trillion shortfall in what they actually have to give out and what they've promised to the workers. Keep in mind, the U.S. economy is built on debt, assets, and confidence. Based on that last example, our next recession, we know that asset prices are very, very close to having big problems. If those asset prices have big problems, then the debt market has a bigger problem because of those corporate buybacks and because right now corporate debt is at an all-time high relative to GDP. And with this $8 trillion coming out of consumer spending, that completely destroys confidence. This whole thing sets up the U.S. economy for another huge financial crisis. Now let's go over how you can prepare. The very first thing that you can do is look at the liabilities of the state where you live. As an example, Alaska, they're underfunded by $102,000 per household. So what that means is that for their pension fund to be properly funded, every single household in the entire state would have to pony up $102,000. In California, $86,000. In Connecticut, $82,000. In New Mexico, $58,000. How on earth are these states going to bridge that gap? What they're going to do is they're going to raise taxes, they're going to decrease services, and the jobs are going to go down. As an example, if you're a business if you're starting a plant or a factory where you're going to have this factory or plant there for 20 or 30 years, are you going to go into a state like Alaska or California? Absolutely not, because if you're a taxpayer, if you're a business, you know that you've got a huge target on your back. So the best advice that I can give you on how to prepare for this upcoming pension crisis is, if you live in one of these states, get the hell out of Dodge.